Hello and welcome to this very special sit-down with the top team at Standard Chartered Bank. We're talking about global growth, global economics, and when we're talking about those things nowadays, there's only one thing which dominates the narrative. This is Mr. Trump and his conversation, his tweets, and his communication, said and unsaid to the outside world. People are left guessing. I'm sitting down with David Mann, who's the Global Chief Economist at Standard Chartered Bank, and Eric Robertson, who's the Head of Global Macro Strategy at the bank. Gentlemen, thank you very much, both of you, for being here.
Thank you.
I think we begin, of course, with the G6+1, the G7 meeting which just finished over the weekend. The way it ended, a statement was put out and Mr. Trump came out and, while on his way to Singapore, tweeted stuff which basically blew up the statement. Your assessment of what that has done to the credibility of the G7 and essentially the partnership?
Well, we would argue that it's been the case for a number of years that the more relevant entity is really the G20. Even though it contains arguably too many economies, it does at least include the ones that are more relevant in terms of accounting for a large share of global growth. These days, Asia accounts for about 60% of world growth if you use PPP exchange rates, and in the G6+1, they're not in there. So I think the amount of attention that's given to communiques coming from the G7 over the years has been going down, certainly compared to 10 or 20 years ago. So in that way, I don't think you'll get a big market reaction. Also, I don't think they should be too shocked that we have seen this sort of more animosity created by some of the tensions through what usually are usually never the case with these allies.
But expectations were already running pretty low, right? I mean, that they will be, to begin with, a joint statement in the first place. But, well, we got that. And then, we got Mr. Trump's tweets.
That's right, and it's therefore no one's really too shocked that whatever the statement ended up being was one that did not get the full support of the largest or most significant member, because we are in a different world in terms of the way that all of these norms work compared to what we've been used to. That's right.
Eric, will this roil Forex markets more? I mean, emerging market currencies have had it pretty bad this year. So
no, I don't think so. And you're correct. It's been a volatile year for emerging markets, but I don't think the tweets from President Trump over the weekend will necessarily exacerbate that. We've gotten used to an environment in the markets where, Trump has made it very clear that he wants to operate, whether it's with trade or other treaties, other negotiations, on a country-by-country basis. And these large multilateral organizations, he believes, are inefficient. So I think this is really more of the same. I think we've got some bigger issues to think about for emerging markets, whether it's the increase in U.S. interest rates or the strength of the dollar recently, oil prices, et cetera. And obviously we have a rather important summit in Singapore this week.
David, but it's very clear, as both of you also agree, that he's made it clear he wants to deal with issues country by country and not on these big forums, right? So what does that really mean? The existing order, as many have put it, is sort of up for renegotiation completely, overhaul?
Well, we've already been going down that route of just piecing together like a giant spaghetti mess, all of the different individual bilateral deals to try and then figure out, can we then turn that into something at least regional and then link the regions together. The WTO process, for example, has been stalled for a lot longer than President Trump has been in office, and protectionism as a trend, that's something that was well underway even 10 years ago. We've been counting the number of protectionist measures taken by various countries over the last 10 years, and actually the US has been implementing more measures than anybody else. So that tend towards being a little bit less into the let's just use up all the low-hanging fruit that's already gone, has already been gone for quite some time. I think what we're focused on now is, can you at least resuscitate some of those regional deals? And I would say the jury is still out on that. But expectations, certainly, what does it matter for the markets at this stage, are very, very low. I think the thing that the markets are more worried about is, do you end up somehow in some sort of negative trade war spiral?
What is the number one issue for markets? Forex markets and other markets, according to you, right now?
I think there's two. The first of which is the Federal Reserve and how far they will lift interest rates.
Sure.
The increase in U.S. interest rates since, let's call it September of last year, has been around 100 basis points in 10-year yields, and more than that at the front end of the curve. So we have seen a significant flattening of the U.S. yield curve. I think for emerging markets more specifically, the increase in the dollar and the increase in oil prices at the same time means that in local currency terms, oil prices have gone up dramatically, and the potential spillover to inflation has now forced some of the central banks in Asia and other emerging markets to raise interest rates to defend their currencies. And I think that's something the markets have struggled with.
Fair enough. But if he were to, as David mentioned, get a trade war spiral, right? I mean, the common view right now is that Mr. Trump is a smart man. He's been a businessman. This is all negotiation, and his opening sort of gambit is pretty tough, and then he kind of sort of waters down, he backtracks, etc. What if other countries were to do the same, and then if it spirals out of control in that sense? I mean, would that be a big worry, or?
It is a concern. For the moment, I think our view is that it remains what we would call a fat tail or a black swan event. I think, as David mentioned, most of the countries involved in these negotiations have taken a very interesting approach, which is to focus on industries or sectors in terms of their retaliation measures, which may garner large headlines, but in terms of the overall economic impact would still be relatively small. Now, if we can stay within that construct where there is a tit for tat, such that both leaders or countries can go back to their voters and constituents and say, we have achieved this victory in our trade negotiations, I think we can avoid that fat tail event. But the risk is still very much out there.
Any way to put numbers, probabilities to this kind of thing?
Well, it's always very hard on probabilities. I would say the probability of having a worldwide trade war of the type that we saw in the 1930s is extremely low. And the main reason I say that is that right now there's really been one main source of the issues, and it's been the US. Others, for example, even with the TPP negotiations, even the RCEP, there are at least some versions of it still out there that people want to continue along that path. There is a coalition of the willing. So it's not as if you have everyone saying, oh, well, it's working for the US, let's all do this. I don't think you're going to go down that path. I think everyone else would rather just ride this out, take the assumption that actually let's follow the actions rather than the words, and there's a big difference still between the two, and focus in on the fact that actually it's still in our interest to continue to stay as globalized as we are, especially with supply chains being as complex as they actually are. One point we make on why we think the US would be suffering itself from doing anything too overly draconian is that the US itself is the fourth biggest supplier within the supply chain of what China sells to the US.
Okay.
So this is a big difference
very,
compared to, say, a long time ago where you didn't have such complex supply chains where everyone was so interdependent. And I think that recognition means that people do want to avoid the worst case. They know what it can do, and they're trying to stay away from it.
But to be sure, we had Canada, I mean, of all countries, coming out and saying that we will not be pushed around. I mean, that was unusual coming in from the leader of Canada, right?
Right, but again, it's very US focused.
Yes.
It's not as if Canada then said, okay, and now we will implement measures, and we're focusing in on our trade with Germany and trying to copy the similar style of what we've seen elsewhere. I think instead it's very zoomed in around one particular trade relationship, an important one, but to be fair, the other interesting part of this is if we zoom it back into this Asia region, is that actually the economic relationship between the US and the markets in Asia has declined substantially from where it was 10 or 20 years ago. Meanwhile, the region itself, particularly China with other markets in the region, that economic relationship has improved, and there's no signs that anyone there is trying to go in that similar direction that we've seen elsewhere.
What would, to you, both of you, constitute a trade war? I mean, at what level will we say, okay, here's the alarm?
Certainly, if you were to take it from the U.S. vantage point, I think if the U.S. were to go beyond aluminium and steel with China, for example, and really implement quite a bit of tariffs against technology companies, impose quite stringent restrictions on China's ability to export technology products into the U.S., or on the other side of the equation to invest or participate in joint ventures. I think for me that would be a telltale sign that we've gone past an important demarcation line. And I think that's where you could see some of the regional trade agreements really start to spiral into a new world. As David mentions, one of the risks and potential silver linings of these trade negotiations is that if the U.S. really does withdraw, you're going to see an explosion in trade deals within Asia or between China and Russia, for example. So I think there's always the other side of that coin.
And you're also not really seeing the U.S. just outright saying, that we want to apply tariffs on everyone, we're going after everyone. Instead, actually, we hear more and more that there are countries in Asia where they don't get that message at all, that actually they're still open for business. And actually, if you look at how world trade has been doing this year, it's growing about as fast, maybe slightly under where it was last year, which was a significant improvement from 2016. So the underlying fundamentals are still looking fairly good, and nothing so far has sidetracked that. Now, what could sidetrack it, I would say a little bit really on something that's a bit too broad, where it's across-the-board tariffs on everything coming in from China. We're going to apply tariffs. And we've looked into some of those tail risk scenarios. And in those scenarios, for example, of, say, China being told everything gets a major tariff, let's say a 25% tariff, there is a significant economic impact. But
the probability of that is very low, as you're saying.
We would say it's quite low, yes.
But India has come up. I mean, I think Mr. Trump mentioned India, saying that, well, India has import duties of 100%, up to 100% in some products, and we can't allow this. And if this continues, then we will stop trading with countries like that. And this is not the first time that India has come up in these trade and sort of protectionist conversations. Have you looked at the sensitivity of countries? Where does India figure in that list if we were to eventually get to a trade war kind of situation?
Well, the way that we would look at it, particularly for, China is not quite as extreme, but in India's case, it's actually not a huge part of the economy, the external sector, compared to the scale of the domestic economy. Now, you can argue, well, if the export sector were hit very hard, that should also feed into impacting on investment. But ultimately, nothing would happen in a vacuum. And you would get reactions, responses, you'd get actions to try and support growth and to encourage more investment. So actually, we don't see that, firstly, as being a very likely scenario. I think it's more a case of watch the actions rather than words. So we don't see that as being high probability, more discussed. And secondly, we don't believe that in itself would have a particularly large impact.